Let me describe two people. Person A wakes up on a Monday morning. Alarm goes off at 6:47. They hit snooze twice, drag themselves out of bed, sit in traffic for 40 minutes, spend 8 hours doing work they're mostly indifferent about, drive home, eat dinner, watch something, go to sleep. Repeat this exact sequence 250 times a year for 40 years until they're 65 and finally allowed to stop. Person B wakes up when they feel like it. They check their phone, not for emails from a boss, but to see how much their assets earned while they were asleep. They spend their day however they choose, not because they're lazy, not because they're lucky, but because at some point they made a series of deliberate financial decisions that eventually made their time their own. The difference between those two people is not intelligence, it's not talent, it's not even income. It's one concept that most people have heard of, but very few actually understand well enough to pursue: financial freedom. And today we're going to break down exactly what it is, what it actually requires, and the specific steps that get you there. No gimmicks, no get-rich-quick fantasies, just the math and the mindset that actually work. First, what financial freedom actually means. Most people define financial freedom as being rich, having a lot of money, a big house, a nice car, and the ability to buy whatever you want without checking your bank account first. That's wealth, and wealth is great, but that's not financial freedom. Financial freedom is a specific mathematical condition. It's the point at which your passive income, money generated by your assets without you actively working, covers your living expenses completely, every month. That's it. That's the whole definition. It doesn't require a yacht, it doesn't require a private jet, it doesn't even require being conventionally rich. It just requires that the money coming in from things you own exceeds the money going out for your life. When that condition is met, work becomes optional. Not forbidden, not impossible, optional. You can still work. Most financially free people do, but they work because they want to, not because they have to. And that distinction changes everything about how you experience your life. Now let's talk about the number. Financial freedom has a price tag, and the first thing you need to do is figure out what yours is. This calculation is called the FIRE number, Financial Independence Retire Early, and the formula is surprisingly simple. Take your annual living expenses, multiply by 25. That's your number. If you spend $40,000 a year to live comfortably, your financial freedom number is $1 million. If you spend $60,000 a year, your number is $1.5 million. If you spend $80,000, you need $2 million. The reason for the multiply by 25 comes from something called the 4% rule. Research from Trinity University in 1998 studied historical market returns and concluded that a portfolio can sustain a 4% annual withdrawal indefinitely, without running out of money, historically speaking. 4% of $1 million is $40,000 per year, which is where the math closes. Now, before anyone panics at the number, the point is not to feel overwhelmed. The point is to know your target, because you cannot navigate toward a destination you haven't identified. Most people are walking in a general direction, hoping to eventually arrive somewhere good. Financially free people have a specific number and a specific plan to reach it. Step 1. Stop trading time for money as your only strategy. This is the foundational shift, and it sounds obvious until you actually examine what it means. A salary is time for money. You show up, you work hours, you get paid. The moment you stop showing up, the money stops coming. There is a direct one-to-one relationship between your presence and your income, which means your income has a hard ceiling. There are only 24 hours in a day. You cannot work more than a certain number of them. So a pure salary strategy caps your earning potential at whatever your time is worth per hour, multiplied by the hours you can physically work. Assets break that ceiling. An asset generates income or appreciation regardless of whether you're working. A rental property collects rent while you sleep. A stock portfolio compounds whether you're in the office or on a beach. A business with systems and employees runs without your constant presence. The path to financial freedom requires building assets, not instead of a salary necessarily, but in addition to it. Your salary funds your life. Your assets fund your freedom. Step 2. The savings rate is everything. Here's something that doesn't get talked about enough. The speed at which you reach financial freedom has almost nothing to do with your income and almost everything to do with your savings rate. Your savings rate is the percentage of your income you save and invest each month, and the math behind it is genuinely surprising. If you save 10% of your income, you will need approximately 30 years to reach financial freedom. That's the conventional retirement timeline. Work for 30 years, save a little, stop at 65. If you save 25% of your income, that timeline drops to around 32 years. Modest improvement. But here's where it gets interesting. If you save 50% of your income, the timeline collapses to around 17 years. Save 75% and you're looking at 7 years. The reason the math works this way is two-sided. Every dollar you save is a dollar that doesn't require coverage in retirement, and every dollar you invest is a dollar compounding toward your number. Higher savings rate means faster accumulation and a lower target simultaneously. Now, saving 50% of your income sounds impossible to most people, and for many people at certain income levels it genuinely is. But the point is the principle. Every percentage point you can push your savings rate upward meaningfully accelerates your timeline. The person who saves 20% instead of 10% doesn't just get there faster, they get there almost twice as fast. Step 3. Invest consistently and stop trying to be clever. This is the part where most people overcomplicate things. They read about options trading. They discover cryptocurrency. They hear about a friend's cousin who turned $5,000 into $50,000 on a single stock pick, and suddenly the boring, disciplined approach feels inadequate. It isn't. Here's the data. Over any 20-year period in the history of the S&P 500, a consistently invested index fund has outperformed the majority of actively managed funds. Not occasionally, not usually, the majority of the time. Study after study confirms this. The people paid millions of dollars to pick stocks professionally can't consistently beat a simple index fund over long periods. The strategy that works for most people building toward financial freedom is almost embarrassingly simple. Invest a fixed percentage of your income every month into low-cost index funds. Don't try to time the market. Don't sell when it drops. Don't chase returns. Just keep buying consistently through every market condition and let compound interest do the work over time. $100 a month invested at 7% annual return from age 25 becomes nearly $260,000 by age 65. Not because of brilliance, because of patience and consistency. The market will crash. It always does, multiple times on the way to your number. The people who reach financial freedom are not the ones who avoided the crashes. They're the ones who kept investing through them. Step 4. Build income streams that don't require your time. Investing in index funds is the foundation, but the people who reach financial freedom fastest typically layer additional passive income streams on top of their investment portfolio. Real estate is the most proven of these. A rental property generating positive cash flow every month is money working independently of your labor. The tenant pays the mortgage, the asset appreciates, and you collect the difference between rent collected and expenses paid. The internet has created entirely new categories of passive income that didn't exist a generation ago. Digital products, online courses, content that generates advertising revenue, licensing intellectual property. None of these are get-rich-quick schemes. All of them require significant upfront work, but the defining characteristic is that the income continues after the work is done. You build it once, it pays repeatedly. The goal is not to have one massive income stream. The goal is to have multiple smaller ones that together exceed your expenses. 3 streams, each covering a third of your costs, is more resilient and often more achievable than one stream covering everything. Step 5. Protect what you build. This is the step nobody puts in their financial freedom plan until it's too late. Inflation erodes purchasing power. Taxes take a percentage of every gain. An uninsured medical event can devastate a portfolio built over decades. A lawsuit, a divorce, a business failure.
Financial freedom is not just about building, it's about structuring what you build in a way that survives the unpredictable. Tax-advantaged accounts like 401ks and Roth IRAs exist specifically to protect your compounding from being taxed into mediocrity. Using them is not optional for someone serious about financial freedom, it's fundamental. Diversification across asset classes, geographies, and income streams means that one bad event cannot erase everything. The person with all their wealth in a single stock, a single property, or a single business is not financially free. They are one bad day away from starting over. Here's the truth about financial freedom that nobody tells you. It is not a destination you arrive at and then stop. It is a series of decisions made consistently over years. Sometimes boring decisions, often uncomfortable ones. Decisions to save when spending feels better, to invest when the market looks terrifying, to build assets instead of buying things that impress people who don't actually care about your finances. The gap between person A and person B from the beginning of this video is not luck, it is not a trust fund, it is not a viral moment or a single brilliant investment. It is the compounding result of small, correct decisions made repeatedly over a long enough period of time. You already know what those decisions are. The question is whether you start making them today or keep waiting for a better moment that never quite arrives. The best time to start was 10 years ago. The second best time is right now. So what's the first step you're going to take? Drop it in the comments. Let's see who's actually serious about this.